The most dangerous investment story is the one everyone already believes. Before the 2008 housing crash, homes looked dependable, mortgage bonds looked sophisticated, and rising prices made risk feel invisible. Michael Burry found the contradiction in something far less exciting: credit data. His lesson still matters because wealth is often built by examining what popular optimism refuses to measure. Burry was not predicting the future through instinct or a mystical signal. He was studying how borrowers actually behaved. Public mortgage records and market data revealed weak loans, rising defaults, and lending standards that could not support the confidence surrounding housing. Subprime mortgages, made to borrowers with weaker credit profiles, carried greater repayment risk. That risk was being packaged, distributed, and treated as if diversification had erased it. According to public filings and contemporary market records, Burry's investment firm, Scion Capital, focused on the underlying loans inside mortgage securities. A mortgage bond was not simply a safe income-producing asset. It was a collection of payment promises, and those promises depended on borrowers continuing to pay. Burry examined the quality of those promises instead of accepting the reputation of the package. That distinction is a powerful investing principle. An asset's label is not its economic reality. A fund called diversified can still depend heavily on one industry. A business described as innovative can still lose money. A property considered secure can still be financed by fragile debt. We create an advantage when we trace an investment back to its cash flow, its incentives, and its failure points. Burry's analysis centered on credit deterioration. When borrowers miss payments, default rates rise. A default occurs when a borrower fails to meet required debt obligations. In housing, defaults can pressure lenders, reduce the value of mortgage securities, and weaken confidence across the financial system. The critical question was not whether every homeowner would fail. It was whether enough weak loans would fail to damage the structure built on top of them. That question challenged conventional wisdom. Many market participants treated housing as naturally stable because homes were tangible, mortgages were familiar, and rating systems suggested that mortgage bonds had strong protection. But complexity can disguise concentration. If similar borrowers receive similar loans in the same rising market, diversification may be less effective than it appears. Different securities can carry the same hidden exposure. Scion Capital responded with credit default swaps. A credit default swap is a contract that transfers credit risk from one party to another. The buyer generally pays a premium and receives compensation if a specified debt instrument experiences a qualifying credit event. Burry used these swaps to position for deterioration in mortgage debt. They could function somewhat like insurance, but they were financial contracts, not harmless protection. The strategy carried serious risks. The housing market could have remained strong, defaults might have stayed contained, or the contracts could have been difficult to value or enforce. Premium payments could accumulate while the thesis appeared wrong. Counterparty risk, meaning the possibility that the other party cannot perform, also matters in derivatives. A correct analysis does not remove uncertainty. It only gives uncertainty a structure we can examine. The market's disbelief became part of the story. Investors can tolerate an unpopular opinion for a while, but patience becomes harder when a position loses money before its logic is validated. Burry faced pressure as the trade required time, capital, and conviction. The lesson is not that stubbornness equals intelligence. It is that a thesis needs defined evidence, a time horizon, and a risk limit before we commit money. For ambitious investors, that discipline is more valuable than copying the trade. We should ask what must be true for an investment to work, what evidence would disprove it, and how long the evidence may take to appear. That framework applies to public companies, private ventures, and career decisions. Conviction without measurement is ego. Measurement without conviction is hesitation. The housing boom also reveals how incentives shape markets. Lenders earned fees by originating mortgages. Financial institutions packaged loans into securities. Investors sought yield. Rating systems helped translate complicated pools into familiar grades. Each participant could benefit while the system expanded, even if the ultimate borrower could not sustain the payment. When rewards arrive early and losses arrive later, risk can grow faster than awareness. Research from financial regulators and post-crisis investigations documented how weak underwriting, leverage, and interconnected mortgage exposures amplified the damage. Leverage means using borrowed money to increase exposure to an asset. It can magnify gains, but it also magnifies losses and reduces room for error. The 2008 housing crash was not merely a story about falling home prices. It was a story about fragile promises multiplied through the system. That broader view changes how we build wealth. Diversification, which means spreading exposure across investments that do not all respond to the same risk, remains useful, but it is not a magic word. We should diversify by economic driver, not merely by ticker symbol. Income, business ownership, broad equity exposure, cash reserves, and skills may respond differently to inflation, recession, or industry disruption. The same thinking improves entrepreneurship. A scalable income stream is one that can grow without requiring every additional dollar of revenue to consume an equal amount of personal time. Software, digital education, specialized services, and distribution systems may offer that possibility, but each carries execution risk, competition, and uncertain demand. The Burry lesson is to inspect the engine beneath the exciting label before investing effort or capital. Suppose a venture claims recurring revenue. We should examine customer retention, acquisition costs, payment timing, and the concentration of major clients. Suppose a business promises artificial intelligence efficiency. We should ask who owns the data, who pays for computing, and whether customers receive enough value to continue. The point is not cynicism. It is intellectual ownership. We stop buying narratives and start testing economics. That mindset can feel lonely because markets reward conformity in the short run. When prices rise, skepticism looks outdated. When peers boast about gains, caution can feel like failure. Yet a crowd can be directionally correct and still misprice risk. We need emotional systems that protect judgment, written assumptions, position sizing, liquidity planning, and a rule against risking money required for near-term obligations. Burry's experience also warns us against confusing a successful outcome with a universally repeatable method. Credit default swaps are complex instruments, and access, pricing, collateral requirements, legal terms, and counterparty exposure can differ dramatically. They are not appropriate as casual tools for most individuals. Unregulated products, leveraged speculation, and hype-driven assets can produce severe losses, and no strategy should be presented as a guaranteed path to wealth. For most wealth builders, the practical translation is simpler. Read company filings, understand debt, compare cash generation with reported profits, and learn how an investment can lose money. Use diversified, regulated investments where appropriate, keep fees and taxes in view, and avoid leverage that could force a sale at the worst moment. General education cannot replace advice suited to an individual's circumstances, but it can improve the questions we ask. Credit data is especially powerful because it turns vague confidence into observable behavior. Are borrowers paying on time? Are lenders relaxing standards? Are prices rising because of productive growth or because more debt is chasing the same assets? These questions apply beyond housing. Consumer credit, commercial property, corporate borrowing, and private markets can all reveal stress before headlines adopt the conclusion. The next opportunity may not resemble 2008, and that is precisely why imitation is dangerous. A warning sign in one era may be irrelevant in another. Instead of searching for a perfect prediction, we can build a process that notices changing probabilities. Scenario analysis helps us consider favorable, difficult, and disastrous outcomes. A margin of safety means leaving room for mistakes rather than assuming our forecast is precise. For professionals and entrepreneurs, human capital is part of that margin. Skills that increase earning power, trusted relationships, and the ability to adapt can strengthen a portfolio more reliably than chasing a dramatic trade. Aggressive growth does not mean reckless exposure. It can mean deliberately investing in capabilities, businesses, and assets with meaningful upside while controlling the consequences of being wrong. The emotional victory in Burry's story was not simply that the housing thesis worked, it was that evidence survived the pressure of consensus. According to the public record surrounding Scion Capital, the trade demanded years of waiting and endured intense doubt before the 2008 collapse validated the core concern. That timeline matters. Being early can look identical to being wrong until the evidence arrives, and sometimes being early is still financially damaging. So we should separate three questions. Is the analysis sound? Is the price attractive? Can we survive the waiting period? An excellent idea at an excessive price may be a poor investment. A correct thesis funded with too much leverage may still end in disaster. And a promising venture without enough liquidity may collapse before demand appears. Wealth grows when insight and survival operate together. The enduring message is not to become Michael Burry, predict every crash, or imitate a complex derivatives trade. It is to investigate the dependency hidden beneath the story. What must keep happening? Who carries the risk? What data would reveal deterioration? What incentives encourage people to ignore it? Those questions turn financial confidence from a mood into a repeatable discipline. Crowded beliefs will always return wearing new clothes. They may appear in housing, technology, private businesses, or the next fashionable investment. Our advantage is not certainty. It is the courage to study boring evidence, the humility to quantify downside, and the patience to let reality challenge the narrative. Wealth with attitude means building boldly, thinking independently, and never confusing popularity with safety.